Good afternoon, fellow traders. Thanks for joining today's webinar about support and resistance levels and trading in FX. It's good to see so many of you here attending today. Before we continue any further, can you just confirm whether you can properly hear me and see the presentation on the screen as well? Excellent. Thanks a lot for the confirmation. Now, while the last people connect to this webinar, let's just go through the disclaimer quickly, and then we'll just kick off the webinar. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So speaking a lot of different languages during the working hours gets my tongue mixed up sometimes. Hope you can bear with me regarding that. Anyways, let's kick off the webinar. Let's take a look at the agenda. I will quickly introduce myself. We'll take a look at two market types you will come across during your daily trading activities. We'll talk about various different types of support resistance levels out there. I will show you how to manually draw and find the support resistance levels and how to manage your risk. And of course, we'll talk about currency trading dangers as well as per standard. And of course, at the very end, you can ask your questions and I will do my very best to answer them to the best of my ability. So please do write them down if you have any questions during the webinar and just ask at the very end. Sorry. Right, so I am one of the senior traders here in Blue Sky Forex, and we do provide 24-hour trade support and analysis just to help all other retail FX traders to make better trading decisions. We are an education, research, and trading group. We do research the market, we develop different strategies, we trade the markets ourselves. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate and help become highly profitable currency traders. So two market types you will come across during your daily trading activities is first price action, aka trending market. You will definitely have heard the expression trend is your friend, which I completely agree to. It is definitely true. However, identifying a proper trending market with proper and significant movements towards one direction is a bit more difficult to identify. And the reason behind this is in order for a significant trending market to carry any weight, for it to be tradable and to be as safe as possible, these movements, they need to be fueled by significant news, right? So there needs to be a significant news release that is driving the price in certain direction significantly. And this way, that certain move is tradable and you can really easily benefit from this large movement, okay? So you do need to have some fundamental knowledge. You'll be able to then analyze what news is causing the market or the asset to move and what is the magnitude of the news and you need to be able to analyze the statistics that is released along with the news just to determine whether it is tradable or not. Okay, just very straightforward. Now, the other market type you will come across is mean reversion, aka ranging market. It is more common, and for that it is easier to identify, and it can be profitable. Support resistance levels definitely carry weight and need to be considered no matter what market type you're trading in. Whether it be a trending market or a ranging market, you will always need to incorporate support resistance levels into your trading decisions. Okay, this is extremely important because support and resistance and understanding how these work are really very the basic knowledge and basic understanding of the market, and not incorporating support or resistance into your trading activities can lead to a lot of bad decisions. Okay, so let's quickly visually take a look at this trending and the ranging market. On the left side, you have a ranging market between the nearest support and resistance levels. The top black line is the nearest resistance, and the bottom black line is the nearest support level. And in the ranging market, the price is bouncing between those levels. As you can see, as the price reaches down to the support, the price is repelled by this level, it bounces back up, and as soon as it reaches the resistance, it bounces back down. Okay, really straightforward. Let's pretend that there was some economic news that hit the market that made the price move. So as soon as the news hit the market, the price broke out from the range. It broke the resistance level and started trending upwards. Now, the price never moves in a linear or a straight line. It does so in waves. So this is where the Elliott wave theory comes into play, and it is useful to know it, however, not completely necessary, to be a successful trader. So Elliott wave theory, if you have time after this webinar, just definitely look into it. It is worth your time. So the waves that are moving along with the trend, they are called impulse waves, and the waves that are move against the trend, they are called corrective waves. The corrective waves usually reach up to perhaps 50 to 65% usually. So you see the correction of 65 or maybe even 70% on this occasion. And as soon as the corrective wave ends, another impulse wave starts and goes along with the same direction again. Okay, a very really easy approach to trading support and resistance levels and incorporating the Elliott wave theory, perhaps including trending lines, would be just to find the end point of the impulse wave and simply trade towards the direction of the trend at the very beginning of the new impulse wave. Okay, so this is a very simplistic approach to trade with the trend. But of course, again, you need to be able to identify whether the trend is significant enough and tradable. When the trend is nearing its exit point, you will see the price experiencing indecision, some exhaustion setting in. As you see, some dojis, setting in here. And then the price starts ranging again. It bounces between the nearest support resistance until it breaks out, starts trending, and after that goes into ranging mode again, etc. So this is how the price essentially moves. Now you will see the price in a ranging market, a very straightforward, very simple to visually analyze. Resistance is repelling the price from going upwards. The support is supporting the price and preventing it from going below that level. Okay. In the trending market, if the price breaks, let's just observe this resistance line, and the price is coming from the left side, right? So the resistance is repelling the price from going upwards at this point here, if you see my cursor. The support level is preventing the price from coming downwards here at my cursor. Now, as soon as the price breaks the nearest resistance level and goes up here, this resistance level effectively becomes the new support level for the price when it is here already. And then you will have a new resistance level just above the price. Now, you will be able to analyze and effectively draw the support and resistance levels onto your chart. I will show this in the MetaTrader 4 as well. It is relatively easy, but it does require a somewhat trained eye to find those points. And of course, this will come in time. Don't worry. If you haven't done this before, I can say with ease of mind that it's still relatively easy. Okay, just need to analyze the price a bit. So as the resistance level effectively becomes a new support level, you see as the new resistance level repels the price downwards, then the newly formed support level is actually preventing the price from going downwards. Okay, so this is how the support resistance levels effectively affect the price movement. Okay, so quite straightforward. Just need you to get your head around it. Why the support and what are the support resistance levels in overall, and why they affect the price that way. Okay. Before going on to the MT4, I want to explain a few different types of support resistance levels that are out there. There are psychological and technical support resistance levels. Okay. The psychological support resistance levels are the ones that you manually draw onto your live price chart that you visually analyze. And then you'll have the round numbers. Okay, I will show the round numbers in a moment. Then you have the technical support resistance levels like floor, Camarilla pivots, Woody pivots, Bollinger based, of course the mark and Fibonacci retracement levels, for example. We will be talking about more of these manual support resistance levels, because these you will effectively draw yourself, and this will be the current support resistance levels for you. The floor and other technical support resistance levels you can very easily find online if you just type into the Google search bar daily support resistance levels. You have a lot of search results that provide you with this information. What are the daily support resistance levels? Different type of support resistance levels are obviously calculated differently. So you just need to find which ones you would like to use, which ones suit you best. I personally use only my own manually drawn support resistance levels and the round numbers. If I notice that the price is becoming really close to, let's say, 1.1, that is a round number. And in this case, I will need to analyze my potential trade entry accordingly. Okay. So psychological support resistance levels, I would say, this is my own personal opinion, that even these support resistance levels that you take from online technically, they are still psychological support resistance levels in a way, because different traders rely on those same technical support resistance levels, and they do make their trading decisions based on those. Thus, these levels effectively do become psychological, right? Because humans, other traders are involving their own psychology and making their own decisions based on those levels, if you know what I mean. Okay. Now on this chart, what you will see, the yellow line, this is a trend line. However, I actually do need to replace this image, because if the price is moving downwards and the trend line is drawn from on the top of the candlesticks, if the price is moving upwards, in this case the trend line is drawn at the bottom of those candlesticks. Okay, but you effectively see here that the trend line is drawn onto the wicks of these candles. I will talk about more about trend lines a bit later when we get into the MT4, what you should keep in mind perhaps, and I will share my own experience with the trend lines and how I do like to use them occasionally. Okay. Now these are the round numbers. For example, for Euro USD 1.1, and simply 1 would be a very round number, and you will experience a lot of indecision around those levels. Most likely this level, if the price is coming from below that level, that resistance level will then repel the price and it will head back down. Okay, because a lot of trade orders are mostly pending orders are most likely set onto those levels, and as soon as the price reaches that, those orders are triggered, and the price moves back in the other direction, if that makes sense. Okay, for the Great Britain pound USD, you will have 1.5 and 1.51 as a round number. Essentially, any value here will be a round number that is that includes a lot of zeros. Okay. So how to apply the SR levels to your trading? It is fairly simple. If you go ahead and browse or initiate the Google search daily pivot points. As I mentioned before, you will have a lot of different websites open that provide you with that information. You need to be aware of the nearest 3 support levels and the nearest 3 resistance levels. These are quite standard from all providers. So what these nearest 3 support levels mean. The very nearest level is obviously the weakest. Then as further from the current price you go, the stronger the support level becomes, and it's the same effectively for the resistance. So S2 is weaker than S1 is weaker than S2, and S2 is weaker than S3, right? So let me give you an example. If you want to initiate the trade based on the nearest support level, you, in a basic way, can initiate a long trade when the price hits the nearest support level, essentially S1, okay? And then set your take profit to the nearest resistance level, R1 in example, and set your stop loss to the next support level. Okay, so this would be a very, very basic way to approach support resistance trading. However, trading at the nearest support resistance levels is essentially 50-50. Okay, because the level is not so strong for it to be a really effective entry point for your trade. It would make more sense to wait until the price reaches the S2 as the daily pivot, or the S3. The S3 would be the best entry point for your trade. And in this case, if you trade on S3, your take profit would be at the S2 level, up from your trade entry. And the same distance below the S3 would be your stop loss. And it goes vice versa for going short when trading at the resistance levels. Again, this is a very, very simplistic approach, trading in the support resistance levels. Obviously, what you need to keep in mind is any upcoming news that might affect the asset movement significantly. If there is no major news impacting the asset, then you can use this approach to trading. I would highly recommend just being very mindful of any second opinions about those support resistance levels, those daily pivots. Usually the websites that does provide this information about those daily pivots, they also share some ideas of those levels. There is usually an expert providing their own insight, what levels the price might test during that trading day. So definitely keep an open mind. Spend a bit more time just reading into those suggestions and examples. So it's definitely worth it. Okay. One important thing to notice or note here is that price really often pierces the support resistance level somewhat, but not significantly. Okay. It is extremely rare when the price reaches exactly the support or the resistance levels and immediately bounces off there. Okay, it usually passes that level maybe around 10 pips, but that's maximum. As soon as it reaches already more than 10, in extreme cases 15 pips, and then you have to consider the support or resistance level to be broken, and effectively that becomes a new support resistance level, vice versa to what it was before. Okay, I will show you this as well on the MetaTrader 4 soon. Before we get into managing the risk, let's actually take a look at the MetaTrader 4 now. I have it open here. Let me just show you how to draw a manual support resistance level onto your chart. Now, how to perhaps and how that certain support resistance level has served as the price reverting point in the past. So just one moment. Okay, 1 second. So here we have the Euro USD chart. If anybody cannot see the MetaTrader 4 chart, just let me know. But everybody should be able to see it. This is a live chart. It is a 1 hour chart. So let's just zoom in just a little bit, right? You see the price moving here. So this is the current point, 23rd of August. Now, let's take a look at the price movement here. And immediately by analyzing this price, I can say that I have one support resistance level here. That is quite a strong level that has actually affected the price quite a lot in the past. So you see how many times the price is experiencing exhaustion around this level, and also the price is being repelled by this level on several occasions, especially here at this point. If you can see my cursor, let's put it like this, you see it easy. Second time here, you have another indecision point here until it broke this level. It went up, and as soon as it came down to this level, you see some indecision setting in, and it goes back up and down around this point. It breaks the level, goes down, comes up again, and again one more time the price is repelled by this level. And every time it comes back up here, you see indecision setting in, right? The price is catching some previous pending orders that have been initiated. Maybe some additional orders are set up as the price is continuously repelled by this level here. And at this point, all the pending orders, they were absorbed, they were consumed, and the price started trending downwards. Okay, so this is a relatively significant support resistance level. Another level that I see by analyzing the price would be around here, because you see a lot of indecision around this point as well. Okay, you see a lot of indecision here. Again, here you have a relatively ranging environment again. One second. This screen sharing stopped for a moment. Okay, it should be on again. Right. At this point, if you can see, I'm sorry. At this point, as the pending orders were consumed and the price started trending in this direction. When the price reached this level, you do see a bit more exhaustion setting in, more than you see here. This is relatively decisive movement, but you see indecision setting in, exhaustion setting in until it breaks this level, right? So you see this level serving as a relatively good support level and resistance level for the price. Now, one thing I want to show you and also find out myself, I hadn't done any price analysis prior to this webinar. Let's just do it on this webinar together. So this is the price action, the price movements that I considered when drawing the support resistance levels, right? I think we can all agree upon this. Now let's scroll back into the past and let's see how these levels played a role in the price action in the past. There you go. Both of these levels, see how extremely well and really precisely the price is affected by both of these support resistance levels. So well, you see how the price quite sharply bounces off this resistance at this point, and on several occasions and quite sharply again, the price is bounced back up by this level here when it served as the support, right? So let's see if it was only the 6th of June I see here. Okay, let's see, we are on 6th of June, the price is at this point and forming onwards from here on, and you determined those two levels being relatively strong support resistance level based on this price action here, and you left those levels onto the price for the next month, right? So in June, okay, you analyze the price on the 6th of June. So on the 25th of June, you see a lot of indecision setting in, a lot of exhaustion setting in around this level when it comes from below up here. And the price is being repelled quite well by this resistance on the 26th of June. If you left these levels onto the chart for another month, you see how these levels really served well for the future price movement, right? So you see how big of an impact the support and resistance levels are to your daily trading decisions, right? The same goes for Fibonacci retracements. We do have even a separate webinar for Fibonacci trading tools where we discuss Fibonacci retracement tools specifically in depth, and the support resistance levels formed by the Fibonacci retracement tools is also extremely important and extremely efficient in repelling the price. Okay, So let's go in further into the past. We see the price being quite away from our drawn support resistance levels. Okay, while it is away from our previous levels, let's analyze this price movement here and draw some additional support resistance line by visually analyzing it. So immediately, what I'm looking for when drawing the manual support resistance lines are these peaks that the price action is forming. Okay, you see quite often at this level you have peaks of the price. You see on several occasions at the very same horizontal level. Okay. Um, if you use this cross indicator on the chart, it's really easy if you point this on a certain point where you see the peak. Let's see, I point it here. Then already from the horizontal line that it's drawing, I can analyze the other peaks that the price is forming and see if they align. Okay, so I see that this level aligns here. It's quite close here as well, and on several occasions you see indecision in the price at this point. So that would be one of the support resistance levels that I would draw around at this point. Okay. Just keep in mind that you should draw it at the very to as much very end points of the wicks as possible by not missing too many of them. Okay, so let's see if I used only these two price or candlestick wicks to draw the support level. You see how I'm missing out from a lot of these other wicks of the candles. So as I mentioned before, the price usually pierces the support resistance level somewhat, so it is completely fine. If you draw it a bit upwards, then you will be including some other wicks onto your support resistance level as well. Okay, so definitely don't include only a few candlestick peaks, right? So another level that I see is around this point that you could visually draw. You see a lot of wicks piercing this point and some indecision in several different places. So drawing this around this point would also serve as quite a good support resistance level. Okay, you see several occasion indecision and exhaustion setting in. And you have a smaller support resistance level at this point as well. And this is mostly relying on quite extreme indecision around this area here. Okay. So these levels were drawn based on this price action. Let's scroll further into the past. Let's see how these levels served. Okay, the lower level, you see a lot of price, a lot of times the price being repelled at these points. Again, exhaustion indecision here. This level not too much because the price was not too much at this point. But you get the point, right? Let's go back to the levels that we drew at when the price was a bit lower. Again, these points do have an effect of the previous price action as well. And of course, this is already going a lot, too much in the past, but you really get the point. You visually see how these support resistance levels, they do play in the role of future price movements. Okay, so we did a bit of backwards analysis right now. We drew the support resistance levels based on the recent price action, and then analyze the price movements in the past. But it works the other way around as well. So the support resistance levels that I drew based on this price action here When the price at some point comes back up here from below, it's safe to say that you will see to some extent some exhaustion and indecision setting in when it hits that point, right? Maybe the price is even repelled completely back down here, where you also have another point around the current price level, right? So somewhere around here you have another level, as you can see, in this exhaustion, indecision, some peaks, being near here as well. Anyways, the price could be bounced back down here onto this level when it does reach this point. So yeah, definitely worthwhile looking into this, practicing to draw these and then identify the support resistance levels effectively. It's really, really important to incorporate these to your trading activities. Okay. Now let's quickly take a look at drawing trend lines onto your chart. Okay. The same principle applies to trend lines. You should not draw these on the very exact peaks of these. They will definitely pierce your trend line somewhat to some extent, right? So let's see, we have a relatively long trend forming here. We'll take a peak before the drop. We'll take this point before the drop, and this peak has the lower high, and if you take 3 of these peaks, that is enough to draw a trend line already. So you could use this one as another lower high, and if we do draw this from here, you will be incorporating these 3 peaks at first, and then making your trading decisions by going short at these points would suffice. Okay. At one point, obviously, the trend line will also be broken. This will always happen at one point. These trend lines or support lines are never indefinite. So when you have gone or taken trades at these points, when the price comes back up to the trend line, you would have earned a bit of profit. Okay, this is just a very first example that I found, just for you to get an idea how to draw a trend line. Even if the price would have pierced the trend line somewhat here, when you are considering, let's say, this peak here, it's totally fine. You will still consider this as one, so to say, a touch of the trend line, and you consider this into the one of the 3 points to draw the trend line. Okay. Let's see if we can quickly find another example. Let's just delete this one. See if we have a proper trending market. Let's see if we can find an upwards trending market here. Okay. This can be a bit of an interesting example because this point would be just the peak before the price reverses and rises, right? I think everybody can agree to that. Now, if we use these 3 points, as this is relatively close to each other, let me just zoom in a bit so you can see better. One second. Okay, so as these 2 points are relatively close to each other, I don't consider these being completely different. And what I will do, I will use this point as the very first point. I will use this as the second point because this is also relatively in a ranging state at this point, I would consider. And I will use this point this or this point, this is essentially the same as the third point to show the trend line. And you will see how the price goes below the trend line at this center here. That's totally fine. It doesn't need to be exactly on the end of the wicks like it is here or at the first point, okay? You don't have to be so strict with these rules. Anyways, if I used these points, and let me just zoom out now, I will extend the line, and you see the price doesn't really even go that far, right? It doesn't really get that far to the trend line. It only reaches the trend line quite late after 1 month approximately, right? Of course, in this scenario, the price, is repelled by this trend line. It is going up, and yes, of course, you could have potentially profited if you had entered the trade here and here and here. But I don't keep the trend line on the chart for so long. Okay, for me, after a few weeks maximum, the trend line becomes insignificant. Okay, if you were to hold on to this trend line for an extensive amount of time, sure, you could have benefited from the upwards movement until this point here. However, if you were a bit not so strict with pinpointing the entry points of the trend line and just considered maybe somewhat the center point of these small waves, then you could have created a lot more trade opportunities at this point and this point and this point here, right? Of course, you see that the price will never reach the trend line around here at this moment. It does pierce it here and fluctuates back and forth at this point. And of course, only at this point, it only really bounces off of it. But still, these would be valid trading opportunities, right? If the price is, you see a strong trend in a certain direction, then you can loosen up the conditions or the accuracy of the trend line just a little bit, right? Of course, at this point, you have a significant rise and have a bit of a trending market. So that is the reason why this is a bit of an interesting example. But nevertheless, you see how the trend line can also be used to pinpoint your trade entries. Okay, it is relatively straightforward. So let's get back into the material, just not to miss out the last bit of content here. You should be seeing the slides now. Okay, so managing risk when using SR to trade or when trading in overall, this is really important. It doesn't only apply to when trading only with support resistance levels. Now, setting risk-reward ratio, or in this case, reward-risk ratio, as you see from the numbers, setting them before you enter the trade is really paramount, okay? I highly recommend determining your risk or reward-risk ratio before you enter the trade, and then modifying your take profit and stop loss levels accordingly. Okay. Now, what is reward-risk ratio? 1-to-1 reward-risk ratio, for example, means that your take profit and stop loss levels are exactly the same distance of your entry price. Okay. Reward-risk ratio of 1-to-2, or sorry, 2-to-1, as you see on the slide, means that your take profit is 2 times the distance of your stop loss, which means effectively that you potentially are you're aiming to gain more from the trade 2 times than you risk losing. So this means that your take profit, for example, if it is 50 pips, then your stop loss is 25 pips. Okay, so your take profit is 2 times the amount of your stop loss. Having a risk-reward ratio or reward-risk ratio of 1-to-1 is completely okay if you are a beginner. It makes sense to raise it positively when you become better, when you are already getting to be an intermediate trader. 2-to-1 is the next sensible level. And of course, the professional traders and experts are already aiming for maybe 3-to-1, 4-to-1, and even 5-to-1. But going anywhere past 5-to-1 is already going to too extreme, right? Because in this scenario, you are creating yourself in a trading environment where your trades barely are capable of meeting your take profit level, and they will most likely reverse by that time and hit your stop loss instead. So don't set too unrealistic reward risk ratio. It does not make sense. Think about it. Think about your own capabilities and trading habits, and figure out appropriate reward risk ratio for yourself. Okay. You can change the reward risk ratio based on the asset, based on the time of day you're trading, based on whether you're trading FX or whether you're trading stocks. It's completely up to you. If you are keeping a static reward risk ratio for all your trades, then you can also, and then it also translates into a static reward risk ratio of your trading session, which is another thing you should do. You should set session goals. Whether you are aiming to gain 500 pips of profit or you are willing to lose or risk losing 50 pips of profit. Okay, in this case, of course, the reward risk ratio is a bit too extreme. It would be 10-to-1. So don't aim for that, because this is something you will not most likely achieve. So definitely apply a proper reward risk ratio for each trade, and of course for your trading sessions as well, and follow that rule strictly. Whichever goal or target you reach first, then simply stop and walk away, just to return on the next session and trade again. Okay, and don't make any exceptions. Another thing to keep in mind is to stay away from martingale. Martingale is extremely dangerous, and you can empty a lot of your accounts if you don't stop using it. It is effectively doubling up your position with consecutive trades on the same asset and in the same direction, just hoping that each and every consecutive trade is aimed to earn back the losses of the previous trade and a bit of profit on top of that. Okay, so you are doubling up your position with each and consecutive trade. Instead of martingale, what you could use is dollar cost averaging. It is a bit similar to martingale, but different in its core. Okay, with dollar cost averaging, you are not doubling up your position with each consecutive trade. What you are doing instead is, let's say that your usual standard lot size is 1. Then if you apply dollar cost averaging, then you will enter the trade, but the first trade you initiate will be with a lot size of 0.3. Okay, and if the price moves against your desired direction, you initiate the second trade with a better price on the same asset in the same direction, again with a lot size of 0.3. So now you have 2 trades open at the same time on the same asset and the same direction. If the price again moves against your desired direction, you initiate the final and the third trade, for example, with a lot size of 0.4. So now you have 3 trades open with the total lot size of 1, just like your standard trade would have been, but considering those 3 trades that you have now open at the same time on the same asset in the same direction, each and every consecutive trade will have a better entry price. Okay, so ultimately you are getting a better average entry price to your trade, but you are still trading with the same lot size ultimately. And if at the very final point the price reverses and goes into your desired direction, you will earn more profits. And if the price still continues in the other direction and you will hit your stop loss, then you will have lost a bit less money because the last trade you initiate, that one earned a bit less losses than the very first trade. Okay, if that made sense, definitely practice it. Now, dollar cost averaging is only effective if your initial trade accuracy is not too high. And what I mean by this is that if your initial trade accuracy is above 65%, then you're better off without dollar cost averaging. That means that you initiate one trade and over 65% of that one trade is successful, then you're fine. Okay, if your initial trade accuracy is below 65%, maybe around 55 or lower, then using this dollar cost averaging will render your portfolio to grow in a positive manner if used properly, okay, and longer term, of course. So keep that in mind. If you have low initial trade accuracy, then use dollar cost averaging. If you're really accurate with your first trade, then you're better off without dollar cost averaging and any other martingale alternative. Okay. And one other thing you could use would be using trailing stops. We do have a separate webinar topic about trading stops as well. Please note that if you are scalping, then effectively you are aiming for a low pip gain trades, maybe 10, 15, 20, 25, or 30 pip gains, then the trailing stop is not really useful. Okay, if you are a position trader or a swing trader, then trailing stops would definitely be a useful tool in your trading arsenal. If you can use trailing stops if you know that you cannot be consistently monitoring the trade that you are in at the moment, and you want to lock in some gains that you have already earned from on a certain asset with a certain price movement, then using trailing stops, you're effectively locking in some gains. Okay, and you don't have to manually modify the stop loss if you are a longer term trader. So last but not least, just few currency trading dangers that you have to be mindful of. Please don't trust bots. Most of them are designed to generate losses on your trading account. Be extremely careful. It is really important. If you do want to try out any trading bot or expert advisor, anything like that, then use them on a demo account at first. This is really important. After you see that this expert advisor or the trading bot is successful and consistently raising your account capital on your demo account without any large drawdown, then only you can set it live on a live account. But obviously you need to still use low lot sizes for safety purposes. Okay. Sad but true, only 5% of the retail traders earn money in FX longer term. And the general cause behind this is human psychology. Okay. What happens is that FX trading in overall and really often is advertised as a really easy way to make money. Okay, you will most likely see a lot of advertisements out there saying, earn $1,000 per day with few clicks of a button or something similar. This is generated just to lure people into making deposits, and obviously they don't know how to trade. They know nothing about the markets, and they are destined to empty their account at one point. Okay. And this is due to human psychology as well, because if you lose fewer trades, you don't know nothing about trading or the market, then you will go into stress. There will be certain chemicals released in your brain, and eventually you will lose the complete capability of analyzing the price, analyzing the market, and you will lose yourself and make stupid mistakes. So you will empty your account. Um, Whoever promoted this easy way to make money will be happy, and the person will never return and will accept the loss and move on. So this is the reason why 95% of the retail traders will not be profitable and lose money. If you want to be part of this 5%, then you will have to educate yourself. You have to be persistent. You have to learn. You have to analyze yourself. You have to be mindful of your own emotions and your trading habits. So that brings me to the next point. Blowing one or two accounts, blowing one or two trading accounts is not necessarily a bad thing. That means you need to change something. You need to change a part of your trading strategy. You have not analyzed yourself enough. You haven't recognized your trading habits, whether they be good or bad. So you need to try harder. You need to push yourself more. You need to focus more. Okay? It's always better, of course, to learn from others' mistakes, but learning from your own mistakes leaves a deeper mark, and you will remember that better. Okay. And last but not least, 5% of signal services, the same thing as with trading bots. These signal services and signal rooms, 5% only are legitimate. So before approaching or engaging with any of these, please do sufficient background checks and ask for audit trails to see the performance and the performance record. It's better to ask any other users what they have experienced with a certain signal provider and signal service. Ask how their account balance has grown or decreased. Just to understand whether you should really jump into trading with any of them or not. Okay. And if you do decide to engage with one of them, then use a demo account at first. If you have been able to generate profit longer term, 4, 5, 6 months consistently without any significant drawdowns, then move to a live account, and again with very low lot size. Okay. So that's it for today's webinar. I am now open for questions. Let me just bring up the questions section, and I'll do my best to answer them. Just one moment, please. Okay, Takaki Sarah is already asking, so the support resistance levels or lines, they don't have to be exactly on top of the candlestick wicks in order to be considered as appropriate support resistance levels. Can they be between or in the center of the candles? Yes, correct. These levels can be in the center of the candles as well. It depends on what chart time frame do you analyze as well. You have to look at the larger picture. If you only analyze, let's say, 30 candles, then you should look for support resistance levels at the as far wicks as possible. But if you're analyzing a larger picture and incorporating maybe months of data, and then it's completely fine if the support resistance levels are drawn in the middle of the candles. This will indicate, but of course, the lines and the levels have to be on the very edge of the wicks of as much places as possible, but in the middle and in some places they can be between or in the middle of the candles. It's fine. Okay, Hashim Agach is asking, please explain me how these SR levels are broken, for example, on 1 hour time frame. Okay, there is no one simple answer for that, because the price action and how the price behaves near those support resistance levels, it is different depending on how many times the price has been repelled by that certain support resistance level, how many times in the recent history, how many times in the further past, how many times the price has pierced that level in the recent history and in the recent past. So all these small factors play a role in the current price action next to that support resistance level. There are no strict rules to consider and analyze from the history price movement. What will the price do now this time when it reaches that level? There are no strict rules. But after you have familiarized yourself how the price has moved around those levels in the past, how it will move around that level this time, and analyzing a lot of different examples on a lot of different um, assets at a lot of different times, you will get your head around um, what the prices may do this time on different occasions. I mean, it only requires very deep price analysis. It requires your attention, and ultimately you will come accustomed to what the price will most likely do around those levels. Now, it has been said that quite often the price does this kind of a W or M formation around significant price support resistance levels. So W or M formation, but it's not always like that. So there are always exceptions. There are always these kind of free cases when this rule or observation simply does not apply. It is like this with trading. Whatever principle you apply to trading by analyzing the market movements, there are always free cases and there are always exceptions. Okay. Okay, Jeremy is asking, when opening my micro account, I selected leverage of 1 to 1,000, which seems to be high. Oh yes, that is very high leverage that you have chosen there. So every time a trade goes against me, small volume but huge amount falls quickly into the red zone. What is an advisable leverage I should use? Um, Now, as I mentioned, 1 to 1,000 is extremely high. This is the first time I actually hear about a broker offering this high leverage. It is advisable to use as low leverage as possible, but the lower leverage you use, the higher account size usually you should have. Okay, so I would say complete maximum of 1 to maybe 1 to 20, or in extreme cases 1 to 50 would be the leverage you should use. But ideally it would be 1 to 1 without any leverage at all. I mean, the best traders, you do not use any leverage. So try to reduce the leverage as low as possible, but just to keep it sensible, not to put yourself into too much risk and to be able to still earn some profits from the market movements. Don is asking, can we also look at the support resistance levels as zones as opposed to lines? Yes, you can, but these are then effectively will turn into supply and demand zones, which we also have a different webinar about. So these supply and demand zones definitely do serve as support resistance, but these are zones in this scenario, and they have to be fundamentally approached a bit differently. Okay. Bioma, yes, the webinar is recorded. We do have webinars recorded already on the same topic in the past webinar section at Hot Forex website. Just log in, go to the webinar section and click on past webinars. You will find a list of recorded webinars there. Sakake is asking, will there be a webinar which focuses on different candlestick chart patterns, double tops, bottoms, flags, etc.? Well, no, we don't have any webinars on these specific patterns, but certainly, I mean, we are keeping those on the shelves right now, and first of all, focusing on the very more basic things just to help the basic traders. We feel that these chart patterns are more for the intermediate traders who have already gone past the basics of trading. So most likely these will come a bit later on. Okay, Festus is asking, do you wait till the candle open or close above the S support resistance level before taking trade, or you trade once the price uh, reaches those levels? Well, it depends on certain cases, but I don't set really any strict rules in regards to that for myself. What I do is I open the trade based on intuition. If I feel that the price can go further up from the resistance level or further down from the support level to some degree, then I also trade in the middle of the candle, right? So if the price has pierced the support line downwards, let's say 10 pips around that, and then I can open a trade in the middle of the candle and trade upwards. That's totally fine. Doesn't have to be like at the close of the previous candle. Okay, Christopher is asking, is it better to set pending orders for the price approaching a support resistance level? And if yes, how many pips it should be for it to obey in most cases? One thing to mention that the price, so to say, obeying the support resistance level, I would not really um, say that the price will ever obey a support resistance level because it may never do so. Okay, it completely depends on the current market condition. Otherwise, yes, you can go ahead and set pending orders. That is totally fine. And you can incorporate this knowledge that the prices quite often pierce the support resistance level, 5, 10, in rare cases, maximum of 15 pips before being reversed, right? Before reversing. So setting a pending order, maybe if you're deciding to go short at the resistance level, setting a pending order maybe maximum of 10 pips above the resistance level would make sense. And of course, 10 pips below the support line if you decide to go long. But again, if you see that the price, reaches the level and exactly from that level bounces off, then you'll be sad because you're missed out a trading opportunity. So I would say it's still best to actively analyze the price action, what the price is doing at that very moment, and then entering the trade. That actually was the last question in the list at the moment, and we are way past the 1 hour mark again. So if you have any questions that you didn't get to ask, then please send an email to webinars@hotforex.com, and they'll be more than happy to answer to your questions as well. From my side, thanks again for attending today's webinar. It was really nice to see so many of you here today. And I wish you safe trading and take care. Have a good day.